Liz, if you see a headline like that, like Trump and Xi are expected to speak soon, but not necessarily today. We got the retaliatory tariffs overnight. What do you think as an investor?
This is not over.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks moved higher on Tuesday as investors assess China's instant retaliation to US President Donald Trump's additional tariffs amid worries about the risk of a trade war. And regardless of some of the worry we had in the market today, this week, over the weekend, stocks were broadly green. And guys, if you caught the lows yesterday in the S&P 500 and the broad market, you are sitting on some pretty good gains for the week. And we saw the leadership today was here in energy, very, very green, along with just the mega caps. Look at Walmart, look at Costco, right? They were very, very green. Look at stuff like Amazon, Tesla up 1.9 and 1% respectively. Apple gained 2%. Nvidia and all of semis was very, very green. Apart from the equipment manufacturers, we also saw gains here in Eli Lilly, Google and Meta on the day as well. And that was really it. Other than that, it was mixed price action in all of the other sectors, with staples being the worst performing sector. Looking at the overall sector analysis, you can see, look at the bottom three sectors: healthcare, utilities, staples, and then real estate also in the red. These are largely defensive sectors, sprinkled with financials right here down 0.27%. They were down today, but financials have performed very well this year and in the last year so far. So definitely today was certainly risk on energy, technology, discretionary communication services. These are sensitive cyclical sectors, risk on sectors against defensive sectors. And that was really the play today. However, there still is angst in this market. We saw gold up 0.88%, and that really has to go with some of the news we got on the tariff front, as well as some of the movement we got in the dollar. Those two elements continue to push up the price of gold, which is actually up about 7 or 8% this year. I think outperforming the large majority of sectors, all things considered. But it wasn't just large caps that gained today. It was also small caps and mid caps. Apart from mid cap core, they were the only losers here today, but inconsequential really. They were flat on the day, down 0.04%. Large cap growth, the outstanding part of the market, up 1.45%, but it was green everywhere else. Here in small caps, mid caps, large caps, in the value components of the market, in the blend components of the market, and even the growth components of the market. Everything gained, but large cap growth, the standout. Nonetheless, no matter where you were positioned in the market, if you were in the major indices, you're definitely looking at a gain today. And if you bought yesterday's lows, you're sitting on some very, very pretty gains, relatively speaking. Now, a big part of the reason why we saw the mega caps really up today had to do with Palantir's earnings. Now, the shares were up nearly 25% at the high point. Investors applauded solid demand for the company's artificial intelligence product, which included higher US commercial and government sales in the quarter. Guys, they reported a double beat and a significant raise, and that's why the stock was up, and that really helped the AI boom. Nvidia, Meta, all of these bigger names move today. They look at these earnings and look at it as a barometer for upcoming demand. Fantastic earnings. And guys, I was looking at the earnings report. This stock has no holes in it, 0 holes. The only thing wrong with it is valuation. Other than that, it's just a perfect business and executing on all fronts. Now, some movers to the downside today. Pepsi was down 4.31%, and I didn't really like these earnings. They beat on sales and EPS. In fact, it actually came roughly in line, a slight beat. However, guidance was the issue, and that's why Pepsi was down 4.31%. Pepsi forecasted annual profits below market's expectations, missed quarterly revenue estimates on Tuesday, and that was on the back of weakening demand for its sodas and snacks. A stock that was also in the green line today was Spotify, up 11%, absolutely on fire. Now, shares jumped 9% pre-market after crushing Q4 earnings. Now, the stock is already up 150% in the past year. Now, it posted full year profit with strong cyber growth, low churn, a double beat, guys, even after price hikes. So, people who use the Spotify product just really like it. They don't want to go to Apple Music. They don't want to go to YouTube Music. They just like the Spotify brand UI, and they're very loyal to it. Now, this comes after a major business overhaul with mass layoffs, a C-suite shakeup and shifting away from podcasts. The result, a huge turnaround from the 2022 lows. And again, investors sitting happy and sitting pretty on these results. All in all, guys, what we really saw in the market was net inflows. Investors sort of came in and just bought the dip. The S&P 500 moved higher. And what we saw was just consistent buying into the close. And this was on the back of some of the trade negotiations. Now, the reason why we actually saw that was because we had tariffs implemented on Saturday, and then Monday we had Canada and Mexico come to the table and China bracing for a trade war. But the reason why we were green today, and part of the reason why we were green today, was because China's new tariffs were seen as a measured response to the US, indicating China don't want to get into an extended trade war. The leadership there probably know their economy can't handle it. And this gave more cause for optimism. And that's why stocks today were actually very, very green. So we had Canada come to the table. We had Mexico come to the table. Trump and Xi Jinping are having a meeting in the next 24 hours to discuss what happens next. And I think we're going to see some very positive news out of that. Now, tariffs are only on hold for a month right now when it comes to Canada and Mexico. Now, trade negotiations are going to continue. We'll see if that 1 month hold period is extended further out. Nonetheless, we're seeing some very, very big moves, and we're seeing some global cooperation with the US to really make the US stronger and also these other countries stronger. Canada securing its own border is good for Canada as well as the US. The same is true with Mexico. And that's why we saw pretty green price action globally today. China was very, very green. Same too with most of Asia, Japan, Southeast Asia, India. Europe, a mixed bag, mostly green. North America was extremely green. Another mixed bag here in South America. Australia was red. South Africa was green. New Zealand was also green as well. Very positive day across the markets. And again, along with the tariff news, we also did get some economic data, softer than expected economic data, and that did help the yield market. Yields came down after we got the JOLTS opening data as well as the factory orders data. Softer than usual. Factory orders came in at 0.9. The consensus was for negative 0.7%. And then JOLTS data came in at 7.6% versus the consensus of 8 million. And the US labor market is cooling, and it has pretty much become a low hire, low fire. Americans that have jobs are keeping their jobs, and we're not really seeing much churn. I don't know if that's a good thing or a bad thing. We'll see as time goes on. Nonetheless, the labor market is cooling, but we're still at that full employment level, and I just don't see anything in the labor market that's really concerning right now. And all in all, for everything we saw today in the market, we saw 4,100 advances, 2,000 decliners, 2-to-1 advances to decliners, and some of the big names here advancing, really helping the markets move in the positive direction. And then looking at market momentum, we continue to see shorter term averages look good, medium term averages look good, and we did see some pretty drastic improvement here. Shorter term averages look good, longer term averages look good, and we did see some pretty drastic improvement here in the medium term averages. 41% of stocks above the 50-day to 47, and then 46 to 49 here in the 100-day moving average. Let's hop on the charts. And then diving into the charts, guys, we see some very risk on sentiment here. However, certain pockets of stocks and indices doing better than others. Look at the IWM, up 1.41%. Look at the RSP, up 0.12%. So again, we are seeing some major buying here in smalls and major buying in large. And then we're sort of seeing like the mid-cap components of the market sort of being shunned away. So markets want the super small stocks and the super big stocks, and the in-between not doing that great today. Now, on the back of everything, the trade negotiations, as well as some of the economic data we got, the 2-year, 10-year, and 30-year yield all fell. The dollar was down 0.42% as well. And that's why we saw metals fairly positive today. Gold up 1%, silver up 1.71%. Bitcoin was down, and then WTI and NatGas was a very mixed bag, with some of the mega caps doing really showing outperformance here, all things considered. And yeah, guys, we did see some weaker than expected economic data. Yields came down, the dollar came down, and that's why I think we saw bigger the big stuff like the Nasdaq 100 and the smalls, the IWM, do very well, with the in-between stocks, the market not really wanting to touch those. And looking at the S&P 500, yesterday we said as long as we hold above the gamma flip, we're buying dips all all the way to 6100 area. Now we didn't get a dip today, a minor wick below yesterday's close, but we've seen some very positive momentum. This was a very strange candle we got. This is a pretty bullish candle, especially if we close here at the top end of the candle. If we can close at the low of yesterday, that would be bullish for us to go ahead and hit the 6100 area. All in all, guys, any dips we do get here, buy those dips, because we are aiming for the 6100 area into this February OPEX period. Not much more to say with the S&P 500. You should already be long and you should be holding to the 6100 area. And the same is true with the Nasdaq 100. You should be long here at the 21,000 area, aiming for the 22,000 area. It's as simple as that. These were simply opportunities, the DeepSeek situation as well as the trade war situation, to get long, because we saw very quick and instant resolutions to them, particularly with the trade war front. You know, Canada came to the table, Mexico came to the table, China's probably going to come to the table, and when Europe gets their tariffs, they're probably going to come to the table as well, because the US has all of the negotiating leverage right now. They have the best economy in the world, bar none. Now, looking at the RTY, very, very interesting developments. We have retaken the gamma flip. Now, yesterday, we were teetering on the gamma flip and put support. We are solidly in there. Now, we did actually go ahead and tether below in negative gamma. However, the bull bought the dip in a very big way, and this is where we are right now. The aim, 23.25. Now, this is a very, very strong level. We found resistance here, on very multiple occasions. Now, this is a strong level of resistance. So what we want to see is a push up above consolidation and then make the next move higher. If we can actually go ahead and get this right here, that would be very, very positive for the market, and probably means we springboard up to go ahead and retake these 52-week highs and the all-time highs just above it, like literally like 50 points above it. So the first big resistance zone here for small caps is this right here, but I love the momentum we're seeing. The buyers came in, bought the dip. Buyers bought the dip right here. And I think if we do get another pullback, we continue to just buy the dip in the IWM, aiming for us to go ahead, break above, and make the next move higher. This was an opportunity to get long. This was an opportunity to get long. And most recently, this was an opportunity to get long. I mean, for those of you that did buy the dip, let's say you bought the put support, you're up 4% in just not even 2 days, like 1.5 trading days. You're up 4%, sitting very pretty on your gains, all things considered. Now, looking at gold, guys, gold just continues to move higher. Look at this. This is literally just like linear returns to the upside, almost parabolic in nature. Gold continues to move higher. And if the dollar continues to move lower and we continue to see these escalated trade tensions, let's say China don't come to the table, I think gold is going to continue to move higher. So gold is that hedge both on the tariff front and the inflation front. And you can see right here, we literally just broke above this level right here. We used it as a resistance on multiple times, and then we just had a rocket ship all the way up. 3,000 incoming for gold. Let's have a look at Bitcoin. We continue to just consolidate here at the top end of this range. Bitcoin tends to have very wide consolidation areas, and then once it makes a low, then onward and upward, and it just tends to rally. But we're just digesting a lot of the gains we got last year. So all of this gains right here, nearly 100% of gains, kind of just digesting at the top end here. What I do know is that smart money, big money, people like Michael Saylor buying at these highs right here. They definitely do like the price below the 100,000 area. And I think we should see 120, 130,000 in Bitcoin before the end of the year, not without some volatility. Now, guys, looking at the dollar, let's quickly look at the dollar. We've seen a lot of volatility. Look at this wick on the trade tension, guys. This is a currency, not like some small cap shitco, okay? This is the US dollar. A lot of volatility as of recently, but we continue to see the move downward. And if we actually look at this right, so that's a high, it's actually a lower high. And if we go ahead, break this low, we would actually make a lower low here in the dollar, and that would signal the downward trend that we've seen from these highs all the way down. Nonetheless, we do have to break this 107 area, and I would even say maybe, yeah, the 107 area. We do have to break this 107 area before anything significant happens and before we actually see a capitulation lower in the dollar. If we hold this level right here, we're probably going to range trade in this area right here. And I actually wouldn't be surprised if for the first 6 months of the year, traded between the 107 and 110 area. Pretty wide range, but currencies are volatile right now, especially with a Trump president. presidency. And then let's look at the 10-year yield. The dollar and yields have sort of been tracking each other, but what we do see is less volatility in yield and a continued move downward here in yields. We're at this very critical level. I know you're not supposed to like do technical analysis on yields, but if we do break here, it probably does signal that we do go lower. Yields tend to trend more than anything, and we saw a trend here, and now we're seeing a downtrend. Hopefully we can get to these lows right here. 4.1% 10-year yield, that would bode very well for stock across the board, smalls, mids, and large. Now guys, for the rest of the week, the goal is simple. In the S&P 500, we're aiming for the 6100 area. The Nasdaq 100 is the 22,000 area, and then the RTY is the 2300 area. You want to lean bullish, and unless we actually get a massive market moving event that's going to derail everything, I think we just continue to climb the wall of worry, because that's generally what we do with stocks in this time of the year. February is volatile, but we normally climb the wall of worry nonetheless. So my opinion, any dips we do get, like we have here on Monday, buy those dips.
Now guys, let's dive into sentiment. And this week I asked you a plain and simple question. And if you want to take part in these polls, thank you to all 941 of you who voted. If you want to take part in these, go ahead, subscribe, and you will see these in your feed every Saturday night. You can go ahead, participate, and be a part of the community. Now this week I asked a very simple question. How are you feeling about the S&P 500? Are you bullish, bearish, or neutral? And the S&P 500 is the flagship index of the US market, as well as probably the world. It's just the 500 biggest publicly traded companies in the US reconstituted every single quarter. And this week, 59% of you guys were bearish. That definitely had to do with the tariff news coming into Monday's open session. 59% of you were bearish, but the minority of you were bullish. 15% of you were neutral. And when you see this type of capitulation, to be honest guys, that's probably more of a buy signal than it is anything else. This type of sentiment is definitely the reason why you probably wanted to get long on the pullback we got Monday. Not even thinking about a resolution to the trade situation, just looking at sentiment and what this community said. Looking at it now, in hindsight, this right here was the reason to get long Monday. And for those of you that did actually get in on the lows, particularly on the futures open, the pre-market open, you're very likely sitting on at least decent gains looking at the week ahead. Nonetheless, there was a lot of fear going into yesterday, and sentiment was certainly bearish. Now guys, and this is bearish sentiment going into the month of February. Now February isn't really a spectacular month. You can see that the first half of February generally returns about 0.5 percentage point. The second half of February tends to be flat. So you see an average return of about 0.2 to 0.5% in the month of February. I guess you could call it flat. Nonetheless, this is what seasonality looks like. And February tends to be very, very volatile. We see ups, we see downs throughout the month. And what do we see? Generally a flattish end to February. So guys, there's going to be a lot of volatility in the month of February. There's going to be a lot of volatility in 2025. Your job as an investor is to embrace the volatility and take advantage of it where you can. But you also need to pay attention to the fundamentals. And right now, analysts are slashing earnings forecasts. And the reason why we've seen a downtick in earnings, and this is forward 12-month earning estimates, guys, is simply because of tariffs. Costin from Citigroup said that if sustained, the latest tariffs could reduce S&P 500 earnings forecasts by about 2 to 3% nominal. Now that's a lot, especially considering that we are expecting to see 14% earnings growth this year, and that is tangible. Now this doesn't account for even further tightening impacts in financial conditions or changes in the consumer or corporate behavior. This simply has to do with tariffs, and Citigroup is actually flashing a warning right here, saying if an extended trade war is to come to fruition, that could be detrimental to S&P 500 earnings. But should we be concerned? According to the data, not necessarily, because we do know that the macro backdrop is very, very strong. And guys, when we do have decelerating earnings, these are the returns when we have GDP decelerating and GDP accelerating. You can see that the average return when GDP is decelerating is 1.8%. However, 3.1% when GDP is accelerating. And if we actually go to the macro portion of the video, guys, we saw the Fed's GDP now for Q1 tick up in a very big way on the back of the PMIs and retail spending data we got in the last couple of trading days. Now, we went from 2.9 to 3.9%, nearly 4% in the Atlanta Fed's GDP now. The blue chip consensus is at about 2.5, so it really goes to show that what the Fed's looking at is looking very, very strong. And what we saw yesterday with the PMIs is that the ISM manufacturing numbers came in stronger than expected. We were actually looking for a 49.4% level. So guys, for those of you that don't know, anything above the 50% mark is a expansion month over month. Anything below is a contraction. We were expecting a contraction in manufacturing. We actually got an expansion this month. Very interesting. Now, this could be some manufacturing hubs front running tariffs. Nonetheless, manufacturing looking robust in the context of stronger GDP. That is a really, really good sign. I mean, if we get good non-farms at the end of this week, there is simply no more doubting the macro picture. It is strong beyond robust. However, there are concerns. The 5-year break-even inflation rate is pretty much near 52-week highs. And again, this is just the market discounting the impacts of tariffs and what it could mean for the market and the inflation picture. Because at the end of the day, tariffs are inflationary. When you look at PCE goods in 2018 that had no tariffs in them, PCE actually ticked down. We saw disinflation. However, we saw reinflation in the goods that were impacted by tariffs. And this is what we saw in the PCE price index. So all in all, guys, this is why the market is actually repricing inflation expectations for the 5-year break-even inflation rate. It has to do with the fact that an extended trade war will be inflationary, and that could derail the macro environment for a good couple of months, but you do have to look at it in aggregate. The macro is so strong and so robust right now. Now, looking at earnings for the rest of the week, guys, it really does kick off tomorrow. We had a huge day today. PayPal, AMD, Google, everything here on Tuesday, a big Palantir as well. And tomorrow we get Uber. Now, you guys know I've been bullish on Uber. I don't hold a position, but it's been on my watch list for ages. Walt Disney is reporting, Novo Nordisk as well, Toyota, Boston Scientific, Boston Controls, Stanley Black & Decker, Aurora, ODFL is reporting, and that's all before the open. Crazy. And after the close, we get Ford, Qualcomm, ARM, Symbiotic, ASCM, Viking, Align. A crazy day tomorrow after what was another crazy day today in the earnings side. And then data, guys, tomorrow we get the ISM services. So we got the manufacturing on Monday, we got the jolts today, we get ISM services PMI, and I believe we also get the ADP numbers tomorrow. These are just the high impact events. And then we get the non-farms on Friday. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.